There's nuances within the high yield market as well as the emerging markets, which could create a little bit more volatility or a little more risk than you're looking to have on the fixed income ride that you sign up for.
This is 401k Specialist Editor-in-Chief Brian Anderson, and this is the 401k Specialist Podcast. As the Federal Reserve begins cutting interest rates, retirement plan advisors might be wondering how this shift will impact core bond and core plus bond portfolios. Since the rapid rise in interest rates in recent years, fixed income has kind of come back into the spotlight, and it seems like clients have been pouring money into the sector this year as they rethink their asset allocation strategy and look to lock in at today's higher rates. We're going to dive into some actionable insights on navigating fixed income strategies in a rate-cutting environment right after this brief message.
In today's evolving investment landscape, advisors must reassess the fixed income options available in their retirement plans, particularly as their clients age, and seek to enhance their income and diversification. A well-constructed Active Core Plus strategy can help provide participants with broader diversity beyond traditional core bonds. Explore how an Active Core Plus strategy can help enhance your DC plan. To learn more, visit Invesco.com/DC advisor.
Today, we're exploring the world of fixed income with Matt Brill, CFA, Head of North America Investment Grade Credit and Senior Portfolio Manager for Invesco Fixed Income. Matt's going to walk us through the basics of core bond and core plus bond portfolios, how fiduciaries can perform proper due diligence on these investment products, and he'll also highlight some of the sectors and opportunities that are most favorable for fixed income investors right now. Welcome to the 401k Specialist Podcast, Matt.
Hey, Brian, thanks for having me.
Well, let's start with some basics. What makes up a core bond portfolio and what makes up a core plus bond portfolio? And does it need to be one or the other, or can you have both of them in a retirement plan's investment lineup?
Yeah, you don't necessarily have to choose between one or the other. They are different, though. A core bond fund generally consists of the largest, most liquid bond portions of the universe, which would be treasuries, agency mortgages, as well as investment grade corporate credit. They also yield the least versus the plus portion, which is going to be a little bit more risky, possibly a little less liquid. But the plus will give you things like emerging markets, high yield, some portions of the structured credit market. And it does introduce a little bit more risk in the portfolio, but with that, you may get higher total return.
All right, so we've seen some pretty impressive inflow figures so far in 2024. How is today's market and economic environment impacting fixed income or bond investing?
Yeah, so there's been a real question for the last couple of years of when inflation would get under control, back to the more normalized 2 to 2.5% that the Fed wants it at. And of late, we've seen a little bit of weakening in the labor market, but overall, the economy continues to do fairly well. So there seems to be a better balance now than in the past year or so between inflation as well as the labor markets and growth. So that's generally good. That means that the Federal Reserve, which has been restrictive for the last couple of years, should be getting less restrictive going forward, which generally should be positive for bond funds.
Okay. Now, how does the Fed's decision to start cutting interest rates factor into your approach to managing fixed income and selecting bonds for the portfolio?
Yeah, so the last couple of years, as the Fed was hiking, as well as just holding rates at a high level, it was somewhat like swimming upstream or running into the wind. Now it's a little bit more like running with the wind at your back. So with the Fed cutting rates recently and likely on the path to cut more consistently going forward, that generally should be good for risk taking. It should be good for adding bonds in the portfolio as well. And overall, we think it should cause a little bit less resistance to this slowing economy. So we will be a little bit more bullish on credit assets, things like high yield, things like emerging markets and other areas of investment grade credit that probably will do better in an economy if it does with the Federal Reserve cutting rates rather than if the Fed were being very restrictive on their financial policy.
All right. So now that the Fed has begun cutting interest rates, are there some certain sectors or industries that are looking more favorable right now when it comes to fixed income investing?
Yeah, so if you think about why the Fed was at a high level or hiking in interest rates in the first place, is there was just too fast of growth and too much inflation, and they wanted to slow that down to get price stability. And with that, though, it required a little bit of pain by the consumer and a little bit of pain by the labor market. Hopefully not too much, and they're trying to kind of engineer what we call a soft landing. But overall, it was generally negative for the consumer that the Federal Reserve was making borrowing very expensive. So as they start to cut here and make borrowing costs a little bit cheaper, generally it should be good for the housing market, should be good for borrowers of things like agency mortgages, non-agency mortgages, but also just the lower end consumer and the retail space should do well as the Fed starts to ease here. One area that we also like is banks, which banks are essentially a derivative of the economy. And if you believe the Fed is able to pull off a soft landing, then you should be able to see banks perform well in this environment versus if we were to head into a recession.
Now, where does core bond or core plus bond fit into an institution or individual's long-term investment strategy, like retirement, for example?
Yeah, so for retirement funds and for other areas, generally people are looking for fixed income for three things. First is income. Getting fixed income is a nice consistent cash flow to be receiving, particularly in retirement. But you're looking for income, you're looking for preservation of capital, and you're also looking for diversification away from equities. So those are generally the three things that investors are looking for. With a core fund, as I stated earlier, you're generally going to get a little less yield, but you're a little more higher quality. Versus with a core plus fund, it introduces a few additional risks, but if done appropriately, may actually still result in more yield and still be able to give you the overall theme and feelings of why you bought a bond fund in the first place, which are those of income, preservation of capital, and diversification away from equities.
Okay. Now, how should fiduciaries perform due diligence on core bond and core plus bond investment products? Is it simply performance versus the benchmark and the universe, fees, or are there other factors that need to be considered?
Yeah, well, I think it's kind of all of the above. So certainly, from a fee standpoint, lower fees make it easier to give good returns. Just a lesser hurdle for the manager to have to get over. But I would say, in general, sometimes you can get what you pay for. So if you're paying for a passive fund that's very low fees, you may not get all the interesting dynamics that you can get with active fixed income that we think can add value over time. So sometimes paying up a little bit can be beneficial. But also, when you think about bond funds, looking for them to be stable, the income producing, diversification, and capital preservation, you also need to make sure that it's high quality enough. So if you choose a bond manager that introduces too much risk in the portfolio, it may look and act a lot more like equities than fixed income. So you need to make sure that you're balancing those out, looking for a manager that can add a little bit of spice to the portfolio without taking on too much risk.
Interesting. Okay. Now, what should advisors be wary of when it comes to the plus component of their core plus bond fund? How much latitude is there for portfolio managers with the plus component in terms of risk?
So generally, for most core plus funds, particularly our own, you have about a 20% cap on high yield securities. You'll generally have a cap on emerging market securities as well, or non-domestic securities at least. So you want to look at how much exposure a particular fund could have to EM or high yield or other areas of the structured credit market. Again, having some exposure could be good. Having too much exposure might be bad. So you just want to be familiar with it. Make sure that you don't think you're adding too much risk in there. And then also, not all high yield or not all emerging markets are created equal. So within the high yield space, there's going to be some things that are called distressed credits, which could be a little bit too much risk. You also have things in emerging markets like local currency emerging markets, which basically introduces foreign exchange risk into your portfolio as well. So there's nuances within the high yield market as well as the emerging markets, which could create a little bit more volatility or a little more risk than you're looking to have on the fixed income ride that you signed up for.
Well, you've covered a lot here already, but let's wrap up with a tip or two for advisors on what they need to be thinking about when it comes to educating their clients about these asset classes.
Yeah, so first off, just remember that active fixed income, we do believe adds value. Also, take a look at extending out of cash. T-bills, CDs, money market funds have essentially record amounts of dollars in them. And we think investors may be served but well by stepping out the curve, by adding a little bit of duration, moving out of the overnight portion of the curve into 3, 5, 7 year type securities. But overall, we think it's a good environment for bonds with the Fed cutting rates. It should be the wind at your back, as I stated earlier. And I just think overall, if the Federal Reserve is able to execute this soft landing, which we think is likely to occur, being in something like a core plus fund may be more favorable than a pure core fund.
Right. Definitely looks like a soft landing is on the way. All right, to Matt Brill, head of North American Investment Grade Credit and Senior Portfolio Manager for Invesco Fixed Income. Thanks for sharing these insights on core bond and core plus bond funds on the 401k Specialist podcast.
Thanks, Brian.